Have you ever noticed something strange? You earn more than you did 5 years ago. Your job title sounds better. Your life looks more comfortable from the outside, and yet, your bank balance feels just as tight as it always has. That isn't bad luck. And it isn't because you're irresponsible. It's something quieter, more structural. It's lifestyle inflation. Let's walk through a very normal scenario. Imagine a 28-year-old professional living in the US or Western Europe. They land a solid job paying about $65,000 a year. After taxes, healthcare, and social contributions, take-home pay is roughly $3,800 a month. That sounds reasonable. Rent for a modest apartment, about $1,400. Utilities, internet, phone, $250. Groceries, and basic living costs, $450. So far, nothing excessive. Now comes the adult life part, a car lease or loan. $420 a month. Insurance and fuel, another $180. Student loan payments, $300 credit card balance from normal spending, $150 minimum payment. Suddenly, we're already around $3,150 per month. That leaves about $650. This is where lifestyle inflation quietly finishes the job. Streaming subscriptions, eating out. After work, upgrading a phone that technically still works. A weekend trip here, a few impulse buys there. By the end of the month, that $650 is gone. Not wasted. Just absorbed. And the key point is this. Nothing in this lifestyle looks reckless. This is considered normal. Here's the hidden mistake most people don't see. Now, let's slow this down with simple math. That $420 car payment isn't just $420. Over 5 years, it's about $25,000. For a vehicle that will be worth maybe half that, that $150 credit card payment often hides interest rates of 18% or more, meaning you're paying extra just to stand still. If that $650 left over each month were invested modestly, even at 6% annually over 30 years, it could grow to roughly $600,000. Not through brilliance, not through risk, just through time and consistency. Lifestyle inflation doesn't destroy wealth loudly. It prevents it from ever forming. So why do intelligent, educated people fall into this? Because our brains are wired for relative comfort, not long-term math. We don't compare ourselves to our past selves. We compare ourselves sideways to coworkers, friends, neighbors, social media. And once a higher standard becomes familiar, going below it feels like failure, even if it's financially smarter. There's also a subtle psychological trap. When income rises, saving the difference feels like loss, not gain. Spending it feels natural. Saving it feels restrictive. Over decades, this produces a strange outcome. Someone earning $55,000 but controlling lifestyle inflation may quietly build assets. Someone earning $85,000 but upgrading everything may remain financially fragile. Same intelligence, different relationship with comfort. Financially intelligent people don't live deprived lives. They simply separate earning more from spending more. They don't ask, "Can I afford this monthly?" They ask, "What does this delay long term?" They understand that freedom isn't about luxury now, it's about optionality later. And importantly, they don't rush. They let raises increase margins, not lifestyles. They allow boredom and spending. They make fewer status decisions and more quiet ones. The result isn't dramatic wealth. It's calm. Bills feel lighter. Emergencies aren't disasters. Choices expand slowly. Lifestyle inflation doesn't mean you're bad with money. It means you're human in a system designed to normalize constant upgrading. The moment you notice it, its power weakens. If this helped you see money a little more clearly, you might want to stay around. Consider subscribing or liking the video, not for motivation, but for perspective. Thanks for watching.